Hey there, folks. This is Mitch Firestone with Precision Trading Labs in New York City, and I'm here to bring you the market wrap-up for the week ending May 19th, 2023. Here's the game plan. Here's the game plan for today. I will take a look at the SPY and the QQQs, and we'll take a look at its performance over the course of the last week, and then we'll broaden the horizon to the last rolling month. We'll also throw in the bond market, as well as take a look at the Russell 2000, the IWM. Following from that, we will take a look at the major industrial sectors, the financials, consumer staples, all of those, and we kind of look at 13 of those. And so we'll look at identify areas of relative strength and weakness. And again, we'll look at that for the prior week, as well as, again, the rolling month. We'll then kind of move on to specifically the SPY and the Qs, and we'll break down some key trading levels based on our view of the price action, which is rooted in the concept of supply and demand. And so we'll take a look at some key levels, both to buy as well as to sell at, and we'll also look to see where those levels are in relation to current price. So at that point, then we'll have an idea whether they're immediately actionable, or perhaps we may have to wait a few days for a price to reach those levels. And then lastly, we'll take a look at a few of the symbols that a number of our subscribers like to look at, as well as obviously a whole bunch of other traders. And we'll take a look at the FANG stocks, which I guess really should be the MANG stocks at this point, because Facebook is now Meta. We'll take a look at the Facebook, Amazon, Apple, Netflix, and Google, and then we'll throw in Tesla as well. So that is the game plan for today. Before we go on, obviously the ubiquitous disclaimer here. Everything I'm about to show you here is purely for informational and educational purposes only. Precision Trading Labs. We are not fiduciaries, financial advisors, or anything else like that. So anyway, that's the game plan. So let's take a look here. So here is the week that just concluded. This is a percent change chart that I put together. And so this is showing the Qs, the IWM, and the SPY. And then again, along with that, the bonds represented by the TLT. Our reference date here is the close from the prior Friday. So that's May 12th. The week that just ended, of course, is May 19th. So this represents the 0 point for this percent change here. So we can see that the Qs were up about 3.5%. The SPY was up a little less than 2%, as well as the IWM. This actually represents more robust price action than we've actually seen in about the last 3 to 4 weeks. We've been sort of range bound. And in fact, we can see that from some of the prior price action here. If we go back to May 8th, we can see that there was a very tight week there where the Qs are up about 0.2%, and the IWM is down about 1%. Okay, we go back to May 5th. We can see we were basically flat down to, and the SPY was down less than 1%. Again, a very tight range. Okay, and then right here, if we go back to the end of April, we can see this was an area where things were up about 2% and down about 1 1/3. But in the bigger picture, for weekly action, this is actually all kind of rather a narrow range here. So that's been the market action for the last week, as well as kind of the last month. And then if we look at this from a sector perspective, this is what we were looking at yesterday. Again, these were the sectors for, and again, the same reference point here, where we have the percent change chart. So this again is based on the close from last Friday, the 12th. Okay, and then here is where things finished off yesterday. So we can see technology was the leader here. And then sort of all of these other sectors were up, let's say, about 1 1/3% up to the 4 1/3% for the technology. So we can see all of these. These are kind of the middling sectors here: materials, health, and staples. And then on the downside, retail has certainly been kind of beaten up. because of inflation and lack of consumer confidence. And then in particular yesterday and the last couple of days, there were some bad results announced in terms of earnings weeks by some of the major retailers. I believe Abercrombie and Fitch had some bad results, and I think they announced some preliminary results. I think their actual earnings are not out till next week, but they're already giving a clue that things are not going to be good with them. Foot Locker yesterday announced some bad numbers, and they got beaten up pretty bad. So as you can see, retail is was really down, particularly yesterday, and then real estate and then utilities are also sitting at the bottom yesterday. If we then look at, for the previous week, I should say, if we now look at the rolling month, we can see technology again is sitting up there on kind of right at the top there. Communications has been generally strong over the course of the past month. And then energy has been really, after flying high for about a couple of months, for the last month or so, energy has been kind of giving it all back. Energy was boosted, I believe, in the beginning of March, where there was an OPEC gap, you can call it, where over a weekend they had announced that they were going to be curtailing production. And so energy kind of got a really nice pop out of that. And that kind of carried through, I believe, for perhaps 2 or 3 weeks. But again, as you can see from the last rolling month, it's down about close to 9%. So in terms of what we would potentially doing with these, we are at PTL, we're kind of looking at the technology and the communication sectors, looking for really strong stocks in these regions, and then looking for minor pullbacks in order to then leg into the broader uptrend that some of these stocks are in, but basically utilizing pullbacks into demand zones in order to then leg into the bigger picture uptrend on these. Similarly, in energy, we're looking for minor rallies, particularly in lower time frames, in order to then come up with some bearish trade setups in order to ultimately take advantage of the weakness in energy. So looking for some minor rally corrections into supply zones in order to then express a trade that will again be on the bearish side, and to look for opportunities in that area. And then there are certainly some opportunities within here, but our focus though is kind of looking at the strong of the strong, the weak of the weak, and then looking for essentially some minor corrections in lower time frames in these in order to take advantage of that bigger picture strength or that bigger picture weakness. Okay, so that's kind of that's our general strategy here. If we move on to the to some live charts here, here's where we are in the SPY. So we're looking here. I was kind of looking at both both daily charts as well as the 2-hour chart, and to some degree, the 2-hour is really just effectively a more detailed version of the daily. Obviously, this gives a little more detail, and there's a little more flow to it, and it allows us to basically identify some levels with a little more precision. So here's where we are now. If we go back to here at the end of March, this was a demand zone where we had identified. You can see price kind of popped out of there with a great deal of energy after spending a brief amount of time in here. Okay. And again, if we blow this up here, we can certainly see that price consolidated, and then there was a gap, a little very bullish candle, a pause, and then another bullish candle. And so the expectation was when price returned to this level, we would then see basically another pop out of there, because this was an area of interest where people wanted and institutions wanted to buy. The price only spent a brief amount of time here. So after this exhaustion of sellers, here, where basically buyers had to run up the price chart, it was the expectation when price returned here, there would be some additional buying pressure here because of the fact that the supply of shares essentially disappeared here, and all you had was a demand for shares here. When price returned, we expected that there would be some residual demand here. And so as a result, we ended up kind of seeing a couple of a bounce here, and then when price returned here again, it kind of hit off that front line, and we had a bounce there again. Similarly up here, where that red arrow is, if we go back here, this was an area where we had, again, this was an area where there was a demand had left this region, and essentially by an exhaustion of buyers here. And then when the buyers left, all you had left was a supply of shares up here. And so when price returned to that level after a robust drop out of there, again, we can see price came up, it fell out of that region. And then if we then go back here again, there was a repeat of that behavior. Okay, so that's that whole concept here of supply and demand. And as I put in here, so a supply zone is an area of expected future downward price pressure, and that's created by essentially first a consolidation in the range and then an exhaustion of buyers. Okay, and essentially what happens is the sellers run down the price chart until they encounter willing buyers. And then when price returns to that region, we can expect a fair amount of the time that there will then be residual downward price pressure in order to express some kind of bearish position. Okay, and so that's essentially the principle of the supply zone up here. The principle of a demand zone, of course, is the same, just on its head and opposite. So demand is an area of expected upward price pressure. And then again, this was created by an exhaustion of sellers. Okay, and then the buyers ran up the price chart in order to then create that robust price move out of here. And so the expectation is when price comes back, we can expect to see, again, a fair amount of the time, we can expect to see a bounce. Does it happen all the time? Of course not. This is trading. So nothing is absolute. And then, of course, anything that we set up is done with a great deal of care with respect to risk management, with a risk management plan. Okay, so this is where we are now. And in terms of where there might be some trading levels here, if we go back here now, so let me take you back here in time here. So if we look back here, this is kind of the next level up here where we see some supply. Okay, price dropped here. Notice it consolidates, and then notice that big gap there. And so price dropped out of there, and price has not been back there since. Okay, and so this is where we are right now. So we are actually a very short distance away from there. So if we look here, and what I have here are these trend lines, and they have a percent change level attached to them. So we can see we are actually very close to this level. We're about a little less than 1% away from this level. So we're going to be certainly looking for this level, basically to express some kind of bearish trade. If price ends up coming into this level and consolidates a bit, we could then expect to see this perhaps fall out of, perhaps drop out of this level, and we can express a bearish trade out of there. When we talk about expressing a bearish trade, obviously we're talking about either shorting a stock or perhaps buying a put, or we could perhaps execute a bear put vertical spread there. And of course, we could also execute a bear call vertical spread in terms of selling premium, in terms of using perhaps some out of the money calls. And then of course we sell one call, and then we buy another call on top, so that the call is not naked, and then we can then define and manage risk. Okay, so that's a trading level about 1%. Above. And then after that, there's really nothing in terms of how we look at the market until a long way away, which is here, up here, because everything else that's sitting above here is actually kind of, at least in our view, kind of beaten up. Now, obviously, once there's some additional price movement, things are subject to change. But as of this point, though, if we look up here, we can see that there were some areas of demand, of supply. They've already hit, and then we came up, and then the price reacted to it already. Okay, if we go back here again, we can see there was an area of supply right here. Notice price keeps coming up. It came up here multiple times and is then dropped out of it each time. So this is a clear area of, we can call this resistance, but I wouldn't necessarily call this tradable supply anymore. And it's possible when price comes up here, it may just react to this again. But generally, the way we look at it is the more often price comes up here, the less likely this is to hold. And so price has already been back here, really fought 4 times. Once after this level formed, once, twice, 3, and 4. Okay, so if price comes back there again, is it going to hold? It could, but on a percentage basis, we think it's fairly unlikely. So we don't necessarily we aren't really looking at that as a tradable level there. And so really the first clean, nice level is there. And then there's also perhaps really, I guess, over here as well. And so in terms of what we're looking at now, after the level that's immediately above us here, we really don't like anything much until really kind of, something in at least a 10% distance from where we are now. That's on the upside. In terms of pullbacks into demand, we've got this level right here. Even though it's been hit a couple of times, it was just a very, very glancing blow. I mean, both times it just hit right off the front of the level. There was really no penetration. Consequently, we're only down about, this level's about 3.5% down. We'll keep an eye on it. We wouldn't just take an automatic trade off the front line. But if we see price dig into the level a bit and then sort of start to emerge with a bullish candle in a lower time frame, then we would probably be looking to express some kind of bullish trade out of here. Okay, and then right here is a clean level of demand. Price has not been back here since this form. Price dropped here, based, and then rallied up. And again, we can see there was a significant gap there. And so that's about 5% down from where we are. So those are the levels on the SPY. If we then turn to the Qs, we could then see right here the nearest area of demand, of supply is about 2% up. And if we kind of flash back in time here, and that's I think probably back somewhere right in here. This is an area that we'll certainly be keeping an eye on. And in fact, this probably, we're looking at the 2-hour chart. If we actually change this to a daily, this kind of cleans up a lot nicer. And then this is a reasonable daily demand zone, a supply zone there, excuse me. And then right here, here's another supply zone above. Okay, so those are 2 areas that we might be looking at expressing a bearish trade. Okay, so that first level there, that's about 2% up. And then if we look a little higher, this other one is about 4% right there. Okay, so this one's about 2%, and that's about 4%. On the demand side, we're looking at something right here. There's an area right here that's about 2.5% down. Okay, and that's this little region right here. And then right here, there is a drop, a base, and a rally out of there. That's about 3% for where we are at current price right there. Okay, so that's about a 3% move down there. And then right here, there's about 5.5% down. There's another drop, a base, and a rally there. Notice the gap and the very, very bullish move out of there. Okay, so these are all levels that we're going to be monitoring very closely in the coming week. And again, these would all be levels where we would be looking to express a bullish trade. We'll be obviously looking to see what the speed is, in a sense, how hard, if price starts to drop, how hard it kind of comes back to these levels. And then that'll dictate whether we sort of have an automatic frontline limit entry at the front line, or whether we will keep a closer eye on it and wait to see if price digs into this level and then shows a lower time frame reversal before we then push the button to actually execute a trade. So we'll obviously be monitoring that, and we'll be sharing that with our subscribers. So those are the levels that we're looking at on the Qs. And then turning to some of those FANG stocks, we take a look at Apple. Here's where we are on Apple. So here's current price there. So we have up above, we have a supply zone there, about 2% above where current price is now. And if we kind of go back again in time, right there is, right there, there's that region right here. Price kind of kissed into that, dropped out of it, So we'll be monitoring that. The origin of that level is right there. Okay. Again, because it's already been hit once, we aren't going to necessarily just automatically kind of again do a frontline entry. But again, we'll be looking to do something more like what we refer to as a confirmation entry. We'll wait to see if price goes into the width and then shows a sign of reversal. And at that point, then we will express a bearish trade out of that. In terms of a pullback, these are areas where we would actually, again, these are levels that we're monitoring in terms of a pullback. Right here, we actually have a level on top of a level. So we're almost inclined at times to almost treat this as kind of one bigger level here. But these are two distinct levels here. And so this one's about 5% down, and then this one you can see is about a 1% beyond that. And again, this is a drop, a base, and a rally there. And again, similarly here, these are both areas of minor consolidation and then expected upward price pressure when price returns here. So again, these will be areas in which we can express a bullish trade. Right here, this is an area where we can see there was a major pop out of here with a lot of bullish activity. However, this is really a reaction to that. And so as a result, and that's why this is not, this is why it has that pink box there, because it's really a caution. It's really a caution that even though this looks like it could be a good trading level, it probably isn't. So, but we didn't mark it there. So there's that. And then right down here, similarly, there's a level down here, but because of this trading right back here, we're not wildly enthused about that either. But these levels right here for a bullish trade on Apple, we think could be good, and we may either treat them individually or look at them almost as one larger combined level. We'll see how that plays out. In terms of Amazon, here's where we are in terms of Amazon. And so here's where we are right now. So right now, but when we looked at this last week, and that's why this vertical line is here from May 12th, which is a week before. When we looked at that last week, we had identified that as a supply zone where we thought that perhaps price would likely drop out of it. So right now we can see this zone essentially has done kind of half of its job. Price came up with a reasonable amount of energy here, and now price has been stopped by this zone, but it has not really turned it around. If we kind of zero in on it, though, we can kind of see that there was obviously a very, very bearish candle that formed at the beginning of trading yesterday. This is a 2-hour chart here. So we can see there was a very bearish candle, then another, essentially a very indecisive candle here, although essentially it is bearish though, because we can see that it closed. It's a doji candle, but it really kind of closed right at the bottom of its range, at really almost where it began. But there was that big wick, and then it kind of gave back everything. And then right here again, this is a doji, and this was actually a bullish candle. It kind of gave back. It dropped, and then it kind of pretty much returned exactly where it started during the day. But essentially, what you have is that bearish move, and then essentially some sideways action. So we're going to keep an eye on this tomorrow and see if perhaps if price is going to perhaps drop out of this level, and then we'll see how we treat that. But in order to sort of take a bearish trade out of this level, though, we really need to see a decisive bearish candle that drops out of there. If it just kind of waffles around like that, even if it drifts out of there, we're not going to have any enthusiasm for that. Further up, if this thing actually breaks to the upside, though, these would be areas that we would be looking to, perhaps that would be the next clean area of supply, and that's a fair distance away. Obviously, that's 9%. Similarly, on the downside, in terms of looking for pullbacks into a demand zone, this right here is not really a clean level in here, because this area right here that I'm about to circle, this is essentially, this pop out of there is really a reaction to what happened here. So that's nothing that we're enthused about. But right here, that could be something where we would express a bullish trade, and that's about 8% down there. If we ended up with a sort of a pull, a major pullback and some major downward price pressure. And that, of course, could get, triggered by, the backdrop here of the, the debt ceiling negotiations or the lack of negotiations, if you want to really be accurate. And then, of course, and the other thing that's in the background, of course, is Federal Reserve monetary policy and inflation. So either of those two things really have the ability, almost at any moment, to torpedo the market. Hopefully, that will not come to pass, but we always got to keep in mind what could happen. But if we end up with a major, so if something like that actually triggered, and we were looking at Amazon, and price ended up kind of really coming down precipitously, right here, this would actually be a good area that if it threatened this area here, this would actually be a good area for actually a potential bearish breakdown trade or a breakout to the downside. Because price kind of came up here, it's been back here any number of times. This was a sort of a weak area of demand. It actually has worked a couple of times. If price comes back here with a great deal of energy, it's almost going to be like a knife through butter, probably, and just go right through this. At which point you could see a breakdown from let's say roughly about 101, and that could conceivably head all the way down to 94. So this could be like a nice $6 or $7 breakdown trade. If price came down here with a reasonable amount of energy, once it gets through here, probably the next stop is right there at that demand zone. Okay, so that's kind of the view on Amazon. We take a quick look at Google here. So right here, here's where we are with respect to current price. We have a supply zone here about 3.5% above where we are now. If we go back here, take a quick look at at the origin of that zone here. Let's go back here. So let's try that again. There we go. So right here, there's that area. There's a drop, a base, and then notice that string of very, very red bearish candles there. So price spent a limited amount of time in that zone. There's an exhaustion of buyers here. And so when price gets back there, we're expecting that there is some residual downward price pressure. Okay, so that's about 3.5% above where we are now. And then the next clean area of supply, in our view, is about 14% away. So that's a long way away. And of course, once price action sort of gets into this region, it could end up creating a nearer term supply zone. But as things stand right now, this is kind of what we're looking at here. And this cleans up if you look at a daily chart, because we're looking at the 2-hour now. But this actually cleans up into a daily supply zone. So that would be kind of the next area of where we would short or express a bearish trade. Down here below, we can see near term, there's about 2% down here. There's a demand zone there, another demand zone there, about 4.5% down. And then after that, the next clean one down there is about 14% down. And then in here, there's probably, at that little turn, there's probably another in a lower time frame, probably in a 30-minute chart or even maybe in an hourly chart. There's probably some demand in there as well that can be exploited. So that's the view on Google. We look at Facebook or Meta. Haven't gotten used to that yet. At some point it'll happen. Right here we have actually a daily demand zone there. It looks a little sloppy there because we're looking at it in the context of the 2-hour chart, but that's a daily demand zone in there. And in terms of where we are right there in terms of current price, that's about 4.5% of the way of where we are now. And then if we go down further, that's about that. And then the next thing, and of course, right there, there's the massive gap here, and then that's down about 14%. So if price breaks through here, then needless to say, we're looking at a potential gap fill here. We'll see. We'll obviously keep our eyes on this, but essentially, this would be kind of an area where we might be looking to express some kind of bullish trade, perhaps by using perhaps a bull call, a vertical spread, perhaps. If we look at Netflix, right now, so when we were looking at this again on the 12th, if we go back here, we can see that right there was a rally, a base, and a drop created again by that exhaustion of buyers here, leaving only supply. So again, this is a supply zone up here. And so again, like that other chart that I showed you a few minutes ago, this region has done, to some degree, half of its job. It has stopped the price. It kind of went up, wicked through just a little bit, and then you can see it actually stopped it. And then there was a bearish candle here, if I blow it up here, and then it's kind of trying to poke its head out of there. So, at this point, in a sense, it has started out of the zone, but at this point, it really hasn't shown any commitment to actually dropping. So I think we would probably just kind of steer clear of this and not really consider anything out of here. On the other hand, if it did kind of drop out of here at this point, then we would probably be looking right around 340 in order to perhaps again express some kind of bullish trade from this level down. So you can see right here, it's sitting at around 365. So, that's about a 20 some odd, $23, $24 drop. But we'll certainly keep an eye on this. And of course, along the way, there could be some price action that will create some kind of level, either bullish, either a demand or a supply zone in here, depending on what goes on in the next few days. So while we don't see anything now, once the right side of the chart, of course, starts to fill in, the situation could change. And then lastly, we'll take a look at our buddy Elon, and we'll take a look at Tesla. So right here, we're looking at a daily demand zone right in here, and we're only about 1.5% of the way away here. Take a quick look, as long as we kind of clean that up. So now I just converted this over to a daily chart there, and so now we can clearly see that bearish candle there. That's the left bookend of the level, and then we can see right in here we essentially have three. We have this candle here. Then we have these two indecisive ones, all of which are engulfed by this entry candle in here. And then essentially that starts, even though it's within the base, it kind of starts to drop out of there. And then you can see there's a gap, it drops. And then of course, right there, then there's that massive gap. So this is an area where essentially we had an exhaustion of an exhaustion of buyers at this level. And so at this point, all you had was a supply of shares there, but no remaining demand for them until price dropped out of here. And then, of course, essentially the sellers ran down the price chart until they found willing buyers. Okay, so now price is returning to this level. So this would be an area where we could express some kind of bearish trade. Okay, and again, what we could do, obviously one could short, one could again do a bear put vertical spread, or of course a bear call vertical spread, where we capture and collect premium. So that's the area on Tesla above, and then below, right here we had a drop, a base, and a rally here. And so if we just look to see the distance on that, okay, that's about 6.5% down here. Actually, I already have that line. That's 6.5% there. Then this one is down about 9%. So you can see these are actually somewhat big distances. So it's quite possible you could see some trades here. On the other hand, if it doesn't drop by that much, then we may have to just wait a few days or even into next week until price returns there. It all depends, obviously. Where earnings are not until the end of July, so we already passed the earnings announcement from that about a month ago. So we'll wait to see what we see on Tesla there, and of course then right below. So we have this area here. There's a demand zone here, and then there's a demand zone there about 20% down. So again, that's a great deal of distance. But as we know with Tesla, what looks like a great deal of distance, it could. A retracement back to a level will oftentimes happen sooner than we think. So at any rate, there you go. That's what I got here. That's our market wrap up for May 19th, 2023. I hope you found this interesting and helpful. If you did, we'd be grateful if you please give us a like on our YouTube channel. Also, subscribe to our channel. And then also, if you want to click on the schedule a call link, I or my partner, Ryan Nocera, will be delighted to tell you a little bit more about the supply and demand concept. That's the foundation of our trades. also tell you about the services and education that Precision Trading Labs provides to our subscribers. So anyway, as always, thank you very much for the privilege of your time, and I will see you all next time. Take care. Bye-bye.